Indonesia raised rates while Singapore cannot, and that direct split in central banking mechanics reaches straight into your CPF SA returns. I'm Iggy and I run the numbers on SGX stocks so retirees do not have to guess. I built this channel because I got tired of watching retirees compare their CPF returns to flashy regional yields without understanding what those yields are actually paying for. By the end of this, you will know exactly why your 4% CPF SA guarantee is the tougher deal, not the weaker one. Quick one before we get into it. Longbridge is running a special National Day promotion this month, and if you sign up through my channel, there's an exclusive $100 on top of it. Here's how it works. Deposit and hold your funds, and every day through day 9, you'll collect a piece of a top stock worth $6.10. On day 10, you get a shot at a lucky draw to win shares of selected US stocks worth anywhere from $6.10 to $610. And if your deposit hits $10,000, that's when the extra $100 cash kicks in. Full terms and the regular welcome rewards are both pinned in the comments below. Worth a look if you're already using Longbridge or thinking about it. Alright, let's get into today's numbers. Two central banks took fundamentally opposing paths over the exact same stretch. Bank Indonesia raised rates 3 times across 2 months to stop foreign capital from fleeing the country, whereas the Monetary Authority of Singapore did not raise a rate at all because MAS does not set a policy interest rate. Why this rabbit hole matters comes down to the foundation of your portfolio. This is not a standard dividend stock pick or an individual forensic balance sheet review, but an examination of the underlying monetary engine that governs everything you own. Whether you are compounding CPF and SRS balances or living off cash distributions, this plumbing sets your baseline returns. What happened in Jakarta was an aggressive sequence of emergency hikes. Bank Indonesia delivered 3 rate increases totaling 100 basis points in rapid succession, driving its benchmark BI rate to 5.75%. By late July, policymakers held steady as the rupiah pulled back from severe lows and headline inflation stayed contained within target. The real reason behind Indonesia's aggressive tightening was capital flight rather than an overheated domestic economy. Foreign institutional money was pulling out toward higher yields overseas, crushing the rupiah and threatening heavy imported inflation. Raising the benchmark rate was Jakarta's emergency lever to make Indonesian assets attractive enough to keep foreign capital from leaving. This defensive scramble mirrors a landlord hiking rent on an existing tenant simply to stop them from packing up and leaving. The move was not driven by strong market demand or economic expansion, but entirely by the structural fear of losing the capital base altogether. The real domestic cost landed immediately on local businesses and consumers. While the rate hike succeeded in steadying the rupiah, higher benchmark costs flowed directly into commercial credit and bank loans. Defending a currency against global outflows frequently collides with the urgent need to support domestic economic growth. Malaysia held steady across the causeway throughout this entire period of regional volatility. Bank Negara Malaysia kept its overnight policy rate unchanged at 2.75% without resorting to defensive rate hikes. Malaysia relied on deep domestic institutional capital, led by its national pension system, to serve as a steady local buyer of sovereign debt when foreign sentiment turned negative. Who owns the debt changes everything about a central bank's operational freedom. While Malaysia leans on deep domestic pools of institutional capital, Indonesia remains exposed to foreign demand across newer, short-term instruments. A central bank's ability to resist emergency rate hikes depends far more on who funds its sovereign debt than on policy messaging. MAS does not set a policy rate at scheduled meetings. While Bank Indonesia relies on a benchmark interest rate to control money flows, Singapore manages its entire monetary framework directly through the foreign exchange rate. How MAS actually tightens monetary policy happens through structural currency adjustments. MAS reviews policy at scheduled intervals without holding emergency rate calls, tightening monetary conditions by steepening the appreciation slope of the Singapore dollar nominal effective exchange rate band. There is no headline rate hike to shock markets, but policy tightens decisively. Why Singapore chose the currency lever instead of an interest rate comes down to our economic structure. Total trade volumes dwarf Singapore's domestic output, which means foreign exchange rates exert far more direct control over imported inflation than a local interest rate ever could. A stronger Singapore dollar makes imported food and energy cheaper in local terms, defending purchasing power at the source. Quiet policy is easy to mistake for inaction, but the mechanics are powerful. A silent adjustment to an undisclosed currency band slope produces no theatrical press conferences or headline rate numbers. Yet it pulls an economic lever that systematically cools imported inflation across the entire domestic economy. Capital flight is fundamentally a currency vulnerability rather than a rate issue. Emergency rate hikes merely treat the symptom, whereas Singapore's framework combines an exchange rate mechanism with a massive domestic capital base. led by the Central Provident Fund, to eliminate reliance on speculative foreign money. This structural insulation keeps local guaranteed instruments completely detached from emerging market defensive spirals. You do not need complicated financial jargon to secure an analytical edge. Iggy's Elite Investors gives you zero-day access to full forensic reports ahead of public release, our complete SGX forensic watchlist, and practical cheat sheets for $12 a month. Willy flag copy/Kaya Toast line removed pending your call on the fabrication flag above. So head over to the link in the description to join. Why this connects to your CPF becomes obvious when examining how returns are funded. The CPF special account and retirement account pay a government-backed guaranteed 4% per annum. That return does not function as a defensive spike to halt capital outflows, nor does it compete for fickle foreign deposits like short-term regional paper. CPF SA stands as the toughest benchmark against which every SGX dividend stock must be judged. Because CPF SA represents the highest quality guaranteed Singapore dollar yield in existence, any dividend stock yielding near 4% while carrying balance sheet debt is asking you to take equity risk without paying you a proper risk premium. Singapore companies borrow more cheaply because local financing conditions track SORA and indirect currency adjustments rather than defensive rate hikes. Because Singapore businesses enjoy stable and predictable credit markets, our forensic screen holds management to much stricter standards for balance sheet gearing and debt coverage. A guarantee only means what it is guaranteed against in real purchasing power. CPF SA offers a clean 4% without needing a risk premium for flight-prone foreign capital, whereas emerging market instruments yielding over 7% carry that extra yield precisely to compensate investors for currency volatility and sovereign flight risk. If you cannot name the exact risk a high yield is compensating you for, you have simply taken on unpriced risk. Different economies operate under fundamentally different structural realities. Bank Indonesia did what was necessary to protect its foreign exchange reserves, while Singapore relies on the deep domestic capital base that CPF provides to manage monetary policy purely through currency appreciation. A 4% guaranteed return is genuinely tough to beat once you strip away uncompensated balance sheet risk. Understanding why MAS operates an exchange rate framework explains why your Singapore dollar yield floor remains entirely secure against flashier double-digit headline rates elsewhere in the region. The question to ask every single time you evaluate a tempting yield is what specific risk that payout exists to compensate you for. Chasing a higher nominal percentage without understanding the currency defense behind it is how retail investors end up taking on hidden balance sheet risk. The next time a financial headline compares Singapore unfavorably to a punchier regional payout, examine the currency foundation first. A flashy nominal yield denominated in a currency under active central bank defense is not a bargain, but a clear risk premium you may not need to take. Regional central banking mechanics prove that yield stability always beats nominal numbers. Indonesia hikes defensively to protect foreign reserves, Malaysia leans on established pension buyers, and Singapore relies on currency strength backed by CPF capital. Your CPF SA 4% guaranteed yield is the structural benchmark that every dividend stock on the SGX must clear. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.